So the oil price is going to stay, in our view, between $50 and $70. Of course, you can have this probability of escalation. Then prices go higher. But as a base case, if that's not happening, the market is facing oversupply. The cuts OPEC has done now with OPEC Plus is not enough. We will need next year more cuts. And that means really they have to stick to that. They have even to do more. So that's why the market
more
is...
cuts to how much? Because you're looking at demand of 1.1 million barrels per day right now.
For next year. For this year, the demand growth is even below 1 million. That means demand growth is not great. Supply out of the US and the rest of the world is growing by 2 million barrels. So that tells you why they're cutting this year. Next year, they have to cut at least 500,000 more. So the pressure is on for OPEC Plus to continue cutting. Demand growth is not good. And since I would say the middle of last year, I disagree with you on refining. Refining is starting to see oversupply. We see global refining capacity outstripping demand growth. We see utilization rates dropping, and that means that the market is coming under pressure. Yes, IMO is helpful. It will support, over the course of the change of the year, the middle distillate segment, but in general, the refiners are not doing well, and utilization rates coming under pressure.
Okay, so at what point do you say we break out of that range? So 50 to 70. I mean, where does the US supply fit into
US
this
supply
question?
is a major factor. It will keep on coming for the next couple of years. The supply growth will slow. That's the hope. The problem, of course, is when you say, well, we have another few million barrels of US shale supply to grow. That's great, so you may say you can sit it out, The problem is, let's not forget, you have about 5 million barrels of production that is somewhere right now restrained, You have Iranian supply, you have Venezuelan supply, you have maybe Libyan supply, OPEC Plus has been cutting, a lot of players are not producing for various reasons. So it's not only that US shale supply is still knocking on the door, it is very strongly knocking on the door. So overall, it requires OPEC Plus to maintain market management. But the real big thing that is happening right now is not even oil. Look on natural gas. The natural gas prices are in the cellar, and they are making major pressure. And they're making pressure on what we call the light ends. So all the natural gas liquids, that's ethane, that's LPG, and all that is putting a lot of pressure on the oil sector as well, in naphtha and others. And you can see that the demand growth for petrochemicals right now is really reduced because of the global economic growth not looking good. While at the same time you have a lot of feedstock coming in producing petrochemicals. So the car industry is not booming, right? But you have a lot of petrochemical production coming in trying to sell plastic. So that's the reason why the market is right now not looking good.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.